Welcome to Talk Tickers. Today, we are digging into the absolute implosion of ELF Beauty. This was a high-flying, unstoppable growth stock. That is, until its latest earnings report sent it crashing back down to earth. We're going to break down exactly what went wrong. So let's just start with the headline number, 35%. That's how much ELF Beauty's stock cratered in a single day, right after their Q2 earnings call. And no, that's not a typo. We're talking about the company's biggest one-day drop in years, wiping out billions of dollars in value, just like that. So the big question on everyone's mind is, how on earth does this happen? You've got a company with a 27-quarter growth streak. That's almost 7 years. A brand that's gone viral on social media and a huge new acquisition, and then, boom, it falls off a cliff. Well, we're going to unpack it all. The results, the disastrous guidance that lit the fuse, the headwinds they're facing, and then we'll give you our final call. All right, so first up, let's look at the actual results for the quarter. Because honestly, the headline numbers were, well, they were all over the place. A classic case of mixed signals that left Wall Street scratching its head. You can see the split personality right here. On the one hand, they missed on revenue by about 6 or 7%. That's never a good look. But then, on the other hand, they absolutely crushed it on the bottom line, beating their earnings per share estimates by a whopping 19%. So a miss on sales, a beat on profit, that kind of report just creates confusion. And here's the real kicker that deepens the mystery. This was their 27th straight quarter of growing sales. I mean, very few companies can claim that kind of consistency. So if the quarter itself was kind of meh, but the growth streak was still alive, what could possibly cause a 35% collapse? The answer, and believe me, this was the smoking gun, was the guidance, what management said about the future. This is where they laid out their forecasts for the rest of the year, and it was so bad that investors basically hit the panic button and ran for the exits. Okay, this chart, this is the heart of the whole problem. Just look at what they're projecting for earnings per share. After doing $3.39 last year, they're guiding to just $2.83 this year. For a company that's valued as a growth stock, having your profitability go backwards like that is a massive, massive red flag. So here's where it gets really weird. They're telling the world that sales are going to keep growing at a super strong 18 to 20%. But at the exact same time, their actual profit is projected to fall by 15 to 17%. It's like running faster on a treadmill only to find you're going backwards. This signals one thing: severe margin compression. They're selling more, but making less. So why the sudden squeeze on profits? What's going on behind the scenes? Well, management pointed a finger at two major headwinds that are really starting to batter the business: U.S. tariffs and a pretty worrying slowdown in their core brand. First, let's talk tariffs. This chart tells you the whole story. A full 75% of ELF's products are made in China. That makes them incredibly exposed to import taxes. In fact, management said they expect these tariffs to cost them over $50 million a year. That is a direct punch to the gut of their gross margin. And the second headwind, this one's a little more subtle, but maybe even more concerning. You see that strong sales forecast? Turns out it's getting a huge boost from their recent acquisition, Hailey Bieber's brand, Rhode. If you strip that out and look at just the original ELF business, growth is only projected to be 3 to 4%. That's a world away from the rocket ship growth investors had gotten used to. And to their credit, management didn't really try to hide from this stuff on the earnings call. They confirmed the pain from tariffs. They admitted that this year's new products just aren't the same kind of viral home runs as last year. They said that getting the new Rhode brand up and running is expensive and will hurt profits in the short term. It all confirmed that these headwinds are very real. Okay, so when you put it all together, you've got the mixed quarter, the disastrous guidance, and these really clear headwinds. Where does that leave us? What's our call on the stock from here? We're officially rating ELF Beauty a market perform. And really what that means is that the story has gotten way more complicated. The easy, high-octane growth narrative, well, that's on pause for now. Here's how we're thinking about it. On one hand, the bull case is still there, right? They're still gaining market share. The Rhode acquisition could be a huge new growth engine. And people love their products. But, and it's a really big but, the bear case has gotten a lot scarier. The tariff problem is real, the core brand is slowing, and they've got to pull off a tricky integration. The potential is there, but it's now balanced by some very significant risks. So how do you play this? Well, here's an interesting thought. The options market was betting on about a 13% move around earnings. The stock actually moved 35%. The market was expecting a tremor, and it got a full-blown earthquake. That massive mispricing tells you there's still a ton of uncertainty here, which can be an opportunity. It suggests that more big swings could be ahead, so one idea could be to bet on that future volatility itself.
So there you have it. The ELF beauty growth story isn't necessarily broken, but it is definitely bent. The path forward is going to be defined by a battle against margin pressure and some serious execution risk. This is not financial advice.